David sends in a question. We were talking about, simplifying the tools, doing this. David's working with bull put credit spreads. He says, I just ran the bull put credit spread search. The top return is CRDO with a 25% return and an 87% probability. This is obviously not possible. Yes, it is. And that can't happen. It's not always going to be 15 to 85. 15 to 85. Lower volatility will be, but higher volatility with a higher bid and ask spreads where you have the probability of getting that net credit, 40 cents, potentially at the midpoint, David, with a 2-point spread. There's an 87% theoretical probability the stock's going to be above 135. And there's a probability we could get the net credit. Let's take a look at it on the profit and loss chart. So our numbers here, yeah, it's a little bit wider than we'd like to see. Now this one's perfect. We would be able to most likely buy, I'm sorry, my apologies. Yeah, most likely buy this 133 put at 120. Probably got to get a field price on that. 110 to 130. Now this bid on our 135 sold call, 130 to 190. So the midpoint's at 160. That might be a hard get. I admit that. Okay. I'm not going to say guarantee, David. But if I tried to enter this position, if the market was open now and I saw this using the midpoint and I put in my order, let's just take a look here. Again, the data hasn't updated. We're going to see yesterday's data on this. I'm just going to go to the research and the option research. So I'm not going to see any last trade times updated today. Unfortunately, last trade time was at 9:10, and that was at 2:23. Now, yeah, it's not a high volume other. I know the data was, but the previous option volume is not that high. It's not actively traded. Okay. So what I would expect if I entered this position, David, is if I put in my midpoint net credit at 40 cents, or if I put in an individual leg with my broker, I see this happen on my married puts too, and my bull puts. If I put this in order in to sell this at 160, the first thing I'd see happen is that across the exchanges, on Power Options and on my broker, I'd have the Power Options chain real-time updating with me, David. You're right. I'd probably see immediately the ask price update to 160, the bid price, David, stay at 130, and the midpoint drop to 145. Now, I don't know. I'm not filled yet because I'm entering it as a position with a net credit, but I'd see that change. Now I'm saying the broker wants me to go to 145 to 120. So that's only going to be your 25 cents that you're thinking. And that's what it is. I'm sorry, I'm still in the draw. There we go. I needed the arrow back. Let's say we did do that. Now we're only going to get 25 cents on the 2-point spread. That's going to be exactly in the wheelhouse that you were just mentioning. We're going to be at 12 to 13% return, 14.3, which you're expecting with that. So that's a likely potential. Now, normally I won't go right to the midpoint right away. When I enter one of those spreads, and I want that, and it doesn't fill at that 40 cents I want, I'm going to drop my midpoint by only 5 or 10 cents. I'm going to try to get in at 150. He changed it. The market maker changed it to 145. That's fine. He wants me to get 14%, which is fine. I'm okay with that. I'm going to just lower it to 120. I'm sorry, 150 to get it down to 30 cents, David, and that might still be a 17.6% return. And usually I get filled at one or two of those in the 17 to 18% range with that 85% or higher, playing the midpoint game for, 10, 12, 15 minutes. And then the other ones are in that 14% range, 14.8, 14.9, 15.6. Those are the common returns I see with playing with the midpoint. I know what you're saying, that it's unrealistic because you're saying, hey, if you've got an 85% probability, your average return is going to be 15% on a credit or debit spread. And if we're at a 70% probability, you're going to be at a closer to 30% return. And if you're at a 65% probability, taking a little chance there, you're going to be at the 35 to maybe 37% range returns. And that's usually how it pans out. The market is relatively fair in that sense because, hey, the market knows what we know. If I want a 90% probability, I'm only going to be seeing a 6, 7, 8% return. That's just how it works. The research that I did and everything I did, the back testing and actual trading and so forth, I just found out that longer term, this is typically what I'm seeing. But a lot of times, the average is closer to 15.8 over time for me. 15.8% with an 85%, I should say, or higher, as we saw in that search. The 87s, the 88s, the 89s came in. 85 is usually the minimum that I use. Again, you can change the criteria any way you want. This is just what shows up in the picks of the day, because this is what specifically I do in my account for the portion of my portfolio. The bull put credit spreads represent about 12 to 15% of my total portfolio at any given time. And sorry about that. In that case, that's what my target is, and that's what I found worked best over time. Now we can pinpoint things, right? And you can tell me, Mike, I did bull put credits this entire run on NVIDIA with only a 70% probability, and I was earning 30 to 32% returns every 2 weeks. And you were only making 15.2, 15.3. So I'm doubling up what you're doing. You'd be correct. I can't fault that. What did we just talk about? It was a 14% gain in 1 month, and then a 12.8% gain the next 30 days. Right. Now, over time. Oh, sorry, wrong way. We go over time. We go through this April situation, and I'm not saying that my 85% probabilities would have been any better off during this run, or this drop, or this quick drop, or this quick drop. It's one of the reasons, by the way, that I don't just trade bull puts on one particular stock consistently over the course of the year. It's whatever comes up in the search that matches the criteria that's performed to my expectations and my personal trading goals. Here's a good run, kind of in here. It's just iron, looks like kind of the pattern that we'd want for iron condors, doing a bull put, and the bear call credit, trying to double up. And then here, I don't care if we're at 70, 85, or 90% probability, we all probably got taken out week by week or every 2 weeks out in time. But consistently over long time horizons, same stocks, same stock criteria. Naturally, if I'm using the criteria, the same stocks appear. But, during different testing, use the same criteria over an 18-month, 24-month, 30-month period, different years. The overall return is higher, doing the 85% in 15 than forcing the 70-30. And it's pretty much the same against, you get better return with the 90-10, because you mentioned, David, you say, oh, I want the higher probability, 90 or above, and I'm targeting a 10% return. Well, really, you're targeting like a 6 or 7% return. It's half of what we see with the 85% probability. Mine's 2 weeks out, by the way. That's what I found worked best also. So that's just some of the ideas of that default bull put credit spread. On that note, this is the default, sorry, folks. This is the default bull put credit spread, what we call the weekly bull puts, and also would show under the weekly picks of the day link. But I usually put some adjustments into mine as well. I have open interest of greater than 0 on the defaults. My personal one is usually minimum of 15 to 20 option volume today, a minimum of 10 previous option volume, and an open interest usually greater than 50. I want some liquidity, okay? And so now we've got exactly what you'd expect. We're at Broadcom. Here's an 18% return with an 88% probability. Like I said, sometimes you get the 17.6, sometimes you get the 15.7s, but the average here is around 13s and 14s. And usually I'm taking that's I'm opening 3 of the top 5 or 4 of the top 6, depending on what I have available. Personally, for me, you've heard me say this before, David, and all of you have heard me say it if you've been following me before. I don't trade it. I don't understand it. I don't follow it. I understand it, but I don't delve deep into it. I don't go into crypto. I don't do things like that. So coin, I'd probably not touch in this scenario. I would just skip over it. If I hadn't opened these first 4 and I was opening 4, I'd skip coin, and I'd skip probably Tesla as well, though we were seeing a positive chart in Tesla last week. And Robinhood had that good breakout, because they're being added to the S&P 500, right? So Robinhood had that big jump earlier this week as well. Alphabet's always a good one, but it's a lower return, 11%. That's usually my cutoff. Right here is probably my cutoff. And again, we're going to play that midpoint battle a little bit, David. I'm going to play it for 5, 10, I'm going to say closer to 15 to 20 minutes on the 3 or 4 trades I'm opening until I get the fill price. Hey, for this, I don't get 17.9, but I get 15, I'm fine. If I don't get 15.7 here, but I get 14.9, I'm fine. That's what I'm trying to achieve. That's what I'm trying to accomplish with those moves. Speaking of which, let's just take a look. I think it's settled a little bit, hasn't it? This jumped up big a few days ago, excuse me. There we go. Well, not as big as I thought, but it did have that move. That sudden jump, yeah, there it is. The jump from the 105 range was trending down here, and it jumped up to the 115. So it's kind of waffling about in that area. And that chart I mentioned sort of on Tesla real quick. And it's being slow today. It was loading faster earlier today when I was doing some of the research here. Yeah, so there's that sort of, it been depressed. Remember our high here of around that 410, 420 range, I believe it was, and then it declined sharply. Well, everything did. That's that March to April we were talking about earlier with NVIDIA also. But it was just kind of mid-range here, a little bit up, a little bit down, a little in the news, a little not happy, and then it just started to have that pop move up in the last few days as well. So going from 346 up to 395 now, kind of holding in that area. Well, not holding, it's still moving strongly the last couple days. Well, something interesting to look at, something to consider as well. But yes, that's just a little tip that you might want to consider. Increase your liquidity values, David, on the default. And although this quick view, that weekly picks today, you mentioned CRDO here, that, as you said, 25% return, 87, and the Eli Lilly, the 24% return here, midpoint net credit of 49 cents, again on a 2.5 point spread. At 88, probably a wide bid-ask spread. This is one of the reasons why, although this is a good quick view, and remember, it's only updated once a day. It's only updated at 11 o'clock. It doesn't consistently update during the day. And that's usually when I'm opening my bull puts on Monday or on Tuesday, by the way, David. That's why it's updated at 11. It's following the trading plan that we use for this approach in our portfolio. But I'm always going to the search directly. And on my account, of course, it's my weekly bull puts with just a little bit more kick into the liquidity to get us closer to some of those numbers. So not impossible, maybe not likely, as you mentioned. I'm gonna lose some of this to bid-ask spread fighting, but even if I dropped it to the midpoint, as I mentioned, we entered it at 160. It didn't fill. We saw the market maker across the exchanges. The bid stayed at 130, and the ask now moved to 160, our price that we wanted for the sold option. So now the midpoint's 145. I might drop it down to 150. He's probably not going to give me 150. But I'm going to try 150. So get that 25 cents there if I get filled at the 120. And or 30 cents. Again, apologies, folks, 30 cents there. And I'm going to be kind of happy with that. All right, that 17.6% return. And even if we did just drop it down to 145, we're kind of close to still that wheelhouse. Okay, but I'm going to try it first, right? I'm going to try for that 22% first. Not going to get filled, but I'm not going to play his game necessarily either. I'm going to not go right to his new midpoint. And if it doesn't fill, David, I'm fine. I'll just take one of the new trades from the next selection. But as you saw, doing some of those basic just liquidity adjustments inside the search, and then you can save it as your own search. 15 contracts today, at least 10 yesterday. Open interest, whatever you want, 25, 50, whatever sounds good to you. Let's go 25. I think I'm usually at 20, by the way. And there, so we've taken those out, and like you said, yeah, this is more towards the expectation of what we were thinking. And that's fine. I'm probably taking, as I mentioned, 3 of the top 5. Going to look at the stock chart. Going to look at the company information. Going to see what's been going on. And David's going to see what's been happening. And I'm going to make my choices of which one is going to be the best one for me to enter. Okay. So you're right. There's a lot of times the bid-ask spread hits hard that way. News coming out, and now the search itself is avoiding earnings between now and expiration. That's a preferred default. I'd never enter a credit spread or debit spread around earnings. Maybe a debit spread, but it's going to be a small portion of my portfolio, 1%, 2%, kind of a lottery ticket. Instead of just buying a call, I might do an at-the-money bull call debit spread just to see what happens if I'm bullish on the stock. I might do a strangle or straddle too. But that's a very small portion of the portfolio. I joke about it before. It's kind of like a lottery ticket, which unfortunately, I guess none of us won if we're still here on the webinar from that big one last week. But that's okay. It's, it's to risk really a small portion of the portfolio. But hey, if it pays out and it hits that 200, 300% return. That long call hits that 400% return we saw with the long option finder. Hey, take the family out to dinner this week. Take them out to a nice dinner, something along those lines. That's what it is, right? So it's not a big portion of the portfolio for those earnings plays for me, and something I might do, but I would generally never would do a credit spread, any spread where you can lose 100% of the risk on the trade. If it goes below both strike prices and the bull put credit or the bull call debit, goes above both strike price and the bear call credit or the bear put debit, even with an 85, 90, 95% probability going through earnings, because you never know how the market's going to react to that report. They could beat revenue and they could raise guidance and the stock could still fall. I've seen that happen is because they have a payment or an obligation that has to come out in the next quarter, whether it was from a lawsuit or whether it was from a loan that's coming to maturation or anything along those lines. I've seen the opposite too, that the stock missed earnings, missed profit, but not as much as the market expected. It lost money, but not as much as the market expected. And it missed revenue, but not as much as the market expected. And it gaps up 8 or 10%. They still had bad earnings if you think about it, just not as bad as everyone expected. So they're showing a turnaround in their minds, I guess, and people come in and start buying it. And we've all seen the same thing too. I beat earnings, beat expectations, but oops, guidance out in the future is low too, and the stock falls. Right? So why take the chance with something that you risk 100% of what you invest in the trade? Now, right, we're being smart. I hope that I know I can only risk 100% of what I invest in that bull call debit spread, that at the money bull call debit spread or the bull put credit spread going through earnings. So I'm only going to put up 1 or 2% of my total portfolio. But that's not something I want to do. I just don't want to take that chance. Even though there's only 1 or 2% of my portfolio, I don't want to do that. I don't want to risk 100% of what I invested into that trade for an unknown event with an unknown outcome. Known event with an unknown outcome, I should say. That's what I don't want to do. But again, add some liquidity into the default search, make it your own, save it, David, on yours. And I always advocate going into the search, although the weekly picks of the day view is a great quick view to see what's going on. It's a great quick view to see, hey, what was coming up in the search. But if I'm doing this at 10 in the morning, I don't want yesterday's values at 11. I want to be in the search and see the updated data. David, that's how I would do it. Change liquidity, then save the search as your own. Go into the search. Now you've got the defaults as your starting point, same as mine, but you've got those little adjustments for a little bit of liquidity to filter out some of these things that might have a wider bid-ask spread and what you feel is a less likely return. The more activity you get, what's going to happen? Bid-ask spread is going to condense more towards a realistic. You've got a better chance of getting filled at the midpoint still at those 15, maybe 16, 14.9% returns with our 87, 86, 88% probabilities and more.